Hello, everybody. It's Ty Crandall with Credit Suite, and I'm so excited you could join us for today's show. So today we're going to be diving in and talking about how to get funding, financing, money through the lifetime of your business. We're going to talk about how you get money even as a startup, even when you just have a concept of an idea of a business, all the way through to when you start making revenue, to when you want millions of dollars and are ready to expand, all the way through the funding life cycle of your business. We're going to talk about funding options today that will work for you. So for those of you that don't know me, my name is Ty Crandall. I'm actually the CEO here at Credit Suite. And at Credit Suite, we help business owners get the most money for their business at the best terms. And we do so through offering a ton of options of business credit, financing, loans, credit lines, many of which we're going to talk to you about today. If you have any questions along the way, feel free to give us a ring, 877-600-2487. If you're interested in learning more about getting funding, go to creditsuite.com/get funding. We never charge you a dime of money to help you get financing for your business. So it's free to help us help you along the way. We even negotiate with lenders to help get you the best terms. So anything we can do along that space, please let us know. So the status of a business is the stage, kind of where it is in its life cycle. So some businesses never get past the first stage, right? We've probably heard that before. A lot of businesses don't even make it through year 1 or 3, and the businesses that do have much greater probability of survival. So a business's status defines how it can actually get funding. So try for the wrong kind of funding for a business's status and expect to be turned down. This is typically what I see, and it's the reason that I wanted to do this for you today, because here's the reality. There's a ton of money available for business owners right now. More money than there's ever been, more money than you would ever know what to do with. The problem is what I just described. Most business owners are looking at the wrong place to get the money. They're basically not at a stage in their business where they should be applying for the sources they're applying for. So the goal today is to decode this and talk to you about the stages you're in and the funding that's available in each stage, so you know where to go to actually access the money that's available. So business statuses or stages are generally as follows. You have a seed or a startup phase. You have 6 months in business. Okay, venture capitalists call this the growth or Series A stage. You've got 12 months in business. So venture capitalists oftentimes refer to this as a Series B stage if you're raising money. You have expansion or you're profitable. So these generally correspond to funding stages. Now, I kind of not made these all up, right? What I'm looking at here is these are what venture capitalists that invest money into businesses call the stages of the business life cycle, right? So this actually can be used for you and I too, for the purpose of getting funding, even if it's not from a venture capitalist, just by looking at these 4 stages. Your seed startup, you're just getting going. You're 6 months in, you're a year in, and then you're actually really profitable and expanding. If you think of it the same way as venture capitalists look at your business, then you're going to have a better chance of figuring out what stage you're in and what money is available throughout each of these stages. So seed funding, the earliest round of financing needed to prove a new idea. Okay, so funding often comes from angel investors or lately equity, crowdfunding. There's other kinds of credit lines and financing that are available for startups. So this startup or seed funding round, this is where you have a concept. It's where you have an idea. The business might be going now and generating some revenue, but maybe not be profitable yet. Okay, really, this is more of an idea stage. Okay, then you're really kind of getting into the early stage of the business, which is referred to as startup. Okay, this is when you need funds for the expenses from marketing, product development. This is when you've went from a concept and an idea to actually starting a business that's starting to produce money and revenue, and you need money to be able to pay for the marketing and the things that are needed to grow the business. Growth or Series A round, this is for early sales and manufacturing funds. This is typically where venture capitalists enter the picture. So Series A is basically the first institutional round. This is where most companies will have the most growth. The 6-month benchmark is kind of a rough estimate. Some companies are in Series A for a year or longer. So seed funding and startup, if you think of it like this, seed funding and startup are where angel investors would initially get involved. And we're going to talk about a lot of other funding options as well. And then venture capitalists kind of get involved when you're actually past those early stages, when you're kind of starting to establish a general foundation. Second round, Series B, this is working capital for early stage companies, which are selling products but not yet turning a profit. So what happens in this stage that hasn't happened in previous stages is you're kind of starting to make sales now. You're actually starting to generate sales and make money although you're typically not profitable. You might even be losing money in this stage. Okay, so again, the 12-month benchmark, which this happens in about 12 months, is just an estimate. But here's what's interesting. If you look at this so far, venture capitalists already expect that you went from idea in seed round to starting the business, to actually starting to grow the business, to actually selling products. And this point, they still don't expect you to be profitable. So to me, that's kind of telltale, right? It goes to show that if you're in the early stages of growing a business, it might take you longer to really be profitable than what you think it will be. Venture capitalists look at this and say it could easily be a year or more before you're profitable. So you should take that as kind of a consideration that sometimes it may take longer to actually make the business more profitable than what you think it will be. Expansion profitability, VCs also call this the mezzanine financing. This is expansion money for a newly profitable business. Now you're selling stuff. Now you figured out your margins. Now you're making profits. Now you're expanding, you're scaling, you're growing. And this is the point where, again, you're actually to a point where you have a real scalable business. So according to SBA, about 2/3 of businesses with employees survive at least 2 years, and about half survive at least 5 years. So as one would expect, after the first few relatively volatile years, survival rates flatten out. So what basically SBA and everybody that studies this says is this: if you can make it past year 5, you have a really, really good chance of survival. Okay, but if you don't make it past year 5, that's when most businesses fail, that 0 to 5 years. I'm going to open this. I'm going to see if I can just open a web page here and see if I can show you that graph. Oh, I love this. I love this graph. It's probably one of the coolest I've seen. So you can see here, these are survival rates. This is 100% survival. Okay, 0%. This is how many years you're in business. So this is one of the best graphs I've ever seen to represent this. You can see that from 0 to 1, almost a straight down. You look at that. I mean, that is almost a straight down of failure rates of down to 80%, 20% fail right there. Then you can see that this isn't almost a straight down, but it's close, right? And then almost. So the first 3 years, we can see this goes from almost straight down to this. And then after this, it just really, really, really starts to lower very greatly, right? So in the first 3 years, you go from 100% of businesses being around to 60 about, right? So 40% are gone in the first 3 years. But then if you add another 7 years on top of that, you're only down to 40. So if you think about it, like you lose 40% of businesses in the first 3 years, and 7 years after that, you've only lost another 20%. So the bottom line is the longer you are in business, the greater chance you have of survival. So therefore, a lot of businesses can potentially make it to expansion if they're funded properly. That's what it comes down to. Per SBA, the two biggest reasons for business failure have to do with managers not knowing what they're doing and the business not having access to capital. Basically, the managers are making mistakes that the business doesn't have the cash flow to be able to overcome. So a startup can depend on inventory or equipment. An entrepreneur might have a 401k or stocks for collateral. So any of these are particular financing that can work for startups. Maybe you need to buy inventory. You can get financing for that. Maybe you need to buy equipment. You can get financing for that. Maybe you have a 401k, an IRA, stocks or bonds. Any of that can be used as to pledge as collateral to get financing. Or you may be able to use somebody else's. Maybe you have grandpa, grandma, mom, dad, another investor that has 401k, stocks or bonds. I mean, after all, 75% of business owners get money from friends and family. So you might as well as actually, instead of getting cash from them, make it easier for them to give you access to the money you need by leveraging 401k, stocks, bonds, IRAs. Okay, you could try angel investors in the startup phase, in the seed phase, or in the initial seed phase. As you start to get to Series A, B, etc., that's when you're typically going to bring in venture capitalists. So a startup may qualify for grants, federal, state, local government. If you go to youtube.com/credit suite, we addressed a bunch of these. We've got several webinars where we map out a bunch of different kind of grants you can actually get. Unsecured business credit lines are another option. So as a startup, you can get up to $150,000 in financing. And we'll be talking about many of these options as we jump into today, where you can get up to $150,000 in credit lines that you could take the cash out on, even as a startup. Some alternative lenders offer unsecured bank credit lines too that still work for startups less than a year old. Matter of fact, 3 to 6 months in business, PayPal, Square start to offer you money. Places like creditsuite.com/fundbox, they start to offer you money in a 3 to 6 month time period. A crowdfunding becomes available if you have a unique concept or an idea. So look, we're going to jump in and talk about a lot of the stuff, but just this one slide has like 12 different kinds of financing you can get as a brand new startup business, right? 401ks, 1, stocks, 2, bonds, 3, IRA, 4, on and on. So there's a lot of options here to get money, even as the startup funding phase. So how can startups help themselves? Well, there's a lot of things you could do. Build your business credit. Look, I say this to people all the time. Lenders look at collateral, cash flow, and credit. If you're not good in any of those areas or all of those areas, well, then build your business credit. Give yourself a compensating factor. At least having good business credit might help offset the fact that you have damaged personal credit or don't have cash flow or don't have a bunch of collateral. Okay, use Square and PayPal. Again, as I mentioned, they're two of the easiest sources to get money from 3 to 6 months in business. They don't even do credit checks. They've got like flat fees in some cases of like $500, and they'll give you 30% loan against the money that you're depositing with them. That's huge. Most revenue cash advanced lenders are only giving you 12% of your annual revenue as a loan. They'll give you 30% of the revenue as a loan. So use these sources. Easy money quickly in the process. Use Fundbox. We've got a great link at creditsuite.com/fundbox. They want you to be in business 3 to 6 months, but they'll issue you initial credit line without a credit check in a lot of cases, without even getting any documentation from you. They plug right into your bank account to be able to get the documentation that they actually need. Now, again, in our case, we got like a $6,000 credit line with them. Then we supplied our tax returns. We were okay to do that. Startups won't be able to. We did. They gave us 30 grand. We used the credit. We applied again and got a $100,000 credit line with no credit check. So they can be with you from startup all the way through to expansion. They have credit lines up to 100 grand that you can use with rates lower than 5%. So that's a huge benefit for you. Build a history with these lenders. Build a history with Square, with PayPal. Build your business credit. Build a history with these kind of sources. And if you're starting early, like I said, Fundbox is a perfect example. We started with 6. Now we have 100. Less than a year later, we went from 6 to 100 because we built a relationship with them. We gave them time to see our borrowing history. We borrowed money. We paid it back. We borrowed money. We paid it back. We borrowed more money. We paid it back. And when they see that, they gain more faith in us, and it's easier for us to bump up and get higher approvals. So let's look at some of these specifically. 401k financing. So you can use 401k or IRA as collateral to get financing. There's no penalties, tax penalties, because it's based on IRS proven strategies, and you can get a loan or a credit line for a rate as low as 5% and get the funding in about 3 weeks' time. So you can get up to 100% of the value of what the 401k is worth that's not already placed with an employer. If it's placed with an employer now, the employer might not let you tap into it. But if they don't, then this is a great option to be able to go with because you can use your 401k or somebody else's. There's no consumer credit requirements. There's no cash flow requirements. Even a startup can get approved. You don't need tax returns. You don't need bank statements. You don't need any of that to be able to get approved. Okay, so the idea here basically is that instead of investing a 401k into other people's companies, why not invest it into your own? Does that make sense? Well, it depends on what you're going to do with the business. Okay. Our current business is growing at a rate that's substantially higher than we could ever make if that money was invested with other companies on the stock market. So those are decisions that you're going to want to make. Again, this is basically just investing money into your own business versus other people's. Securities-based financing is when you're using stocks and bonds, much the same, okay? You can get approved even if somebody else wants to let you use their stocks and bonds. Why do I keep saying that? Because 75% of business owners get money from other people. And if you go to grandpa to try to get cash, that if he gives you physical cash, that means he makes less money in interest in his retirement. The amount he makes monthly goes down. But if you use his stocks as collateral, then he still earns the interest. He still gets the returns. He notices no difference unless you were to default on the credit line or loan, then they take the stocks, right? So he doesn't lose anything unless you default. If he gives you cash, Well, then he loses something even if you don't default, because there's downtime where he doesn't have access to his money. So it gives them a safer way to invest in your venture. And it also gives you an easier way to get money from other potential investors. So personal credit quality doesn't matter with this. There's no consumer credit requirements. And they don't really care about cash flow as either. So you can get this even as a startup business. Angel investing. So angels are informal investors. They generally invest in the start of a company. And this is often the swap for the equity of your business. So what's nice about angels is that you don't have to pay them money back until you exit the business. So this means, unlike a loan where you've got to pay monthly payments every single month until the money's paid back, you don't have to pay these guys back. The trade-off is you're giving them ownership interest in the business. So eventually when you do go public, when you do sell the business, for example, you're going to have to pay them a fraction of the earnings that you get. So they can even invest via crowdfunding platforms or what they have now as angel investing networks. So companies can connect to affiliated angels by just asking. Companies connect to unaffiliated. So there's two different kinds here. There's called affiliated angel investors and unaffiliated. Affiliated are simply people that you know. As a matter of fact, unaffiliated people you don't know, real full-blown investors, they like to see that you have these affiliated angel investors involved. The way that people look at it is they're like, I don't know you. So if you have people that do know you investing in your business, then I have more faith and confidence in what you're doing as well. So that's an affiliated angel. You can get in touch with these people by just asking people. Okay. Unaffiliated investors are different. Okay. These are people that you're going to connect with, or companies connect to unaffiliated angel investors much the same way they connect to others who can help them. They just basically are reaching out through cold calling, right? Business brokers, advertising, intermediaries, and networking. Look, the thing to do is to get knowledgeable here. Okay. Pick up books, read books. The books will even map out the exact process. We did a great webinar that tells you everything that you need to know about angel investing on our YouTube channel, youtube.com/credit suite. So that'll give you even more information. But basically, you're doing research to find angels that are out there. And again, if you look at our YouTube video, I even show you over 100 angel investing networks that will help you with that as well, to be able to find the right potential angels to invest. Venture capital. Venture capitalists will give money to help build new startups somewhat if the VC believes the company has both high growth and high risk potential. Here's what's nice about venture capitalists. They respect the fact that you're high risk. They respect the fact that there's a high risk your business may fail. The higher risk that your business may fail, the more appealing they find the offer. That's exactly the same with lenders. Lenders, all of them, everybody that lends money in the lending space of some which way or form, what they're looking at is to stay away from high risk. They want you to be the lowest risk or acceptable risk to meet their standards. Venture capitalists love high risk because it also means you also have, in a lot of cases, the high growth potential. You're taking a huge risk, getting into a segment of the market that maybe hasn't been tapped into. The growth potential is huge and the risk potential is huge. So these tend to be fast growth companies that have an exit strategy. You need to keep that in mind. If you're going to go to angel investors and venture capitalists, they're not going to take money monthly from you, but they're expecting you to exit in 3 to 5 years. They're expecting you to sell the business in 3 to 5 years. So when you meet with venture capitalists, when you meet with angel investors, you need to be prepared to show them a business plan that has you selling the business in 3 to 5 years. If they can't see clear exit potential in 3 to 5 years, they're just not going to be interested. So venture capitalists will often want to recover that money in that time period. They're also going to want a larger stake, a larger ownership stake in the business than will an angel investor. Remember, angel investors contributing much less money than venture capital, could 10 grand, 15 grand, 25 grand. Venture capital may be in the millions. But the difference is these guys, venture capitalists, may want to sit on your board. They may want to control decisions of the company. Angel investors, not so much. Venture capitalists, they may want to play a much more active role in the growing of the business, so want a larger stake in ownership than angel investors. They're going to look that you have a strong management team, a large potential market, meaning a lot of people that your product and service may work for, a unique product or service, something that's not like everything else out there, right? Something that's different, something that, again, has huge risk potential, but also huge growth potential. And they also want to see you have a strong competitive advantage. So VC also seek opportunities in industries they have familiarity with, right? What angel investors and venture capitalists do, they want to provide value to you and your business, but they can't provide value if they don't know anything about you and your business. So they kind of stick with industries and areas that they're comfortable with because they want to own a larger percentage of the business and contribute their expertise to help that business grow. Okay, so because of that, they again want to possibly sit on your board, want to have an influence on the direction of the overall business. So a lot of grants, okay, that you could possibly get into. What's nice about grants is this is free money. It doesn't have to be paid back. Here's the thing. I think that people are too lazy to get grants. I really do. Because if you just take the time to do some research to find the right grant for you, and then you apply, so few percentage of entrepreneurs are actually taking this step that you have a really good chance of getting approved for grants, which is free money to grow the business, just simply because other people are too lazy to take the step. So HUD is an agency which hands out a lot of really good grants. If the business isn't related to housing or city development, then it won't be approved with HUD. That's not the source. But if it is, well, then you can go and search HUD for grants at portal.hud.gov. If you go there, and I'm not going to give you the whole long URL. If you're watching this, you can see it. But if you go to portal.hud.gov, that'll get you to where you can start to look for some of these HUD grants. Now, NOFAs or notices of funding availability include the contact where to send an application. If applying for more than one HUD grant, it has to be a separate application under them. Okay, so you're going to have to fill out a separate application for each grant you apply for. You can also try USDA for rural industries, USDA.gov. Okay, and then you can even go to USDA.gov/topics/farming/grants -loans. So the USA doesn't give grants, just give grants to ranchers and farmers. They also give grants to waste management companies, energy companies, housing preservationists, and providers. So again, you might not think of USDA, but if you're not in a really highly populated area, it may work for you, even if you're not a rancher, even if you're not a farmer in those kind of industries. A state or local grant might provide grants as well. Partnership to the state, city, or town. Ask for local government support for a project. Try to appeal to a specific local government need. Look, a lot of these cities have this. A lot of towns have this. A lot of towns' incentives have incentives that if you start a business there, they'll give you tax breaks. They'll help you get grants and access money to be able to grow the business there, right? We see this all the time. You know, Amazon's building a new headquarters, and all these states are offering them all these concessions to build it in their state. Why? Because states know that if you run a business there, you bring employees, and you basically are driving the entire system. The employees need a place to live. The employees need places to shop. So you're driving the whole ecosystem just by hiring people. So local governments have areas that are dilapidated and run down, and they want businesses to go in there, and they'll give you grants to get in there, because the more businesses in an area, well, the more that it could grow and thrive. So there's all kinds of these local town, city type of actual grants you can obtain. Now, a grant needs to have a grant proposal. These operate really similar to a business plan. A local address is generally a bonus when applying for a grant, meaning if you're applying for a grant in Florida, it's going to help you a lot if you actually have a business and home in Florida. You know, if you're applying for grants down here and you live in South Carolina, then your chance of getting it is not going to be better than me when I live down here. So write a clear and short cover letter. Don't ramble. Get to the point quickly. Check delivery requirements. So I like to think of this as a headline. You know, when you put any content out in the world, then the image kind of stops people in their tracks if you do it right. The headline pulls them in to the content that they're reading, and then, you know, hopefully your content's enough to keep them there reading. Well, same thing here. The cover letter is what pulls them in. So make sure it's short, concise, and it's interesting enough for them to want to read more. And check delivery requirements. How do you send the application in? Mail, in person, fax, et cetera, et cetera. So a lot to do with grants, but don't forget, there are grants in your industry. There are local grants. There are state grants. There are federal grants. There's thousands of these type of grants available. I just touched upon some of the most common. Unsecured business credit line. So unsecured business financing is another option. Okay. Basically, you're using the entrepreneur's assets as collateral. The asset you have is your credit. Okay. This could be personal assets like 401k, et cetera, with some credit lines. But for the most of these, it's based on your consumer credit. But again, as we talked about, it could be 401k, it could be equipment, it could be your credit as the asset, it could be inventory, it could be any asset you have as collateral. And yes, your consumer credit is an asset. So a business owner can get 0% business credit cards with stated income if you're using your personal credit as the asset. No financials are required. You can get up to 150 grand. You need to have good credit for that program to work, a 700 type credit score. It's not a good option for you if you have credit issues, but guarantors work for this program. So again, if you have somebody else around you that has good credit, then that is a great option for you. You can get credit lines up to $150,000. You could get it as a startup, no doc, no bank statements, no tax returns, no collaterals needed. All you need is good credit or the guarantor to have good credit. And if you have it, then you can get a ton of money for startups, very popular, especially with real estate investors. Unsecured bank lines of credit. So some alternative lenders are now offering lines of credit up to 150 grand. Okay, minimal documentation program. So a few bank statements, sometimes tax returns is what they're going to ask for to actually get approved. So typically with unsecured banks line of credit from alternative lenders, they want to see two things: average credit, 650 type FICO scores, and they want to see that you actually have at least 1 year's tax returns that show some kind of profit. It's one of the best pieces of advice I could ever give you. Your accountant will tell you to write off everything and claim a loss at the end of the year. I'm going to tell you differently. You show me a business that has a profit of $5,000 and show me a business that has a loss of $5,000, and I'll show you the business that had a profit, how they could get lines and credit lines and loans, where the one that showed a loss can't. So showing a loss versus showing a profit means a big deal in the funding world. It opens up term loans. It opens up lines of credit. If you want long-term low-rate financing, you need to get your credit scores up. That's going to be important, mid 600 or higher. And then you also really want to focus on making sure that your tax returns show some kind of profit. Even 1 year's tax returns and average credit can get you this kind of financing. Now, over 100 grand, they may want a P&L, they may want a balance sheet, but under 100 grand, they don't even want that documentation. Okay. And you could typically get that line of credit locked down at about 30 days with pretty low rates, 7 to 10%. And again, the approval amount's usually about 10% of your annual sales. So whatever your tax returns show is your sales, you can typically get a loan for about 10% of that. So if your tax returns show you did $500,000, you might be able to get $50,000 with this program, even with average credit, just because you show some kind of profit on the tax returns. And again, better credit is preferred, but at as low as a 650, you can still get approved. Crowdfunding. This comes via platforms like Kickstarter and Indiegogo. It gathers money from a lot of people instead of one big investor. This is the new thing right here. When it comes to business lending, the new thing is combining money from a lot of different people into one fund. So an example of this is crowdfunding. It gets money from a lot of investors and backers and pulls it in one lump sum to get you the money you need. Another example are angel investing networks, where angels are contributing $1,000 or $5,000, but a bunch of angels pool their money together where you can get $50,000 or $100,000, for example. So this is the new thing in lending, peer-to-peer lending. There's so many examples of this pooling of money that you then have the ability to access. So if the crowd likes your idea, they may decide to donate to the project. Typically only works if it's a unique idea. Like, you're not going to get a real estate investor in this work because there's like millions of real estate investors, for example. A good pitch is vital for success. So usually crowdfunding doesn't need to be paid back, but you've got to read the fine print. Some crowdfunding platforms make you give all the money back if you don't reach your campaign goal. This is called fixed or versus flexed funding. You want flex funding, which gives you the ability to still make your money if you didn't earn your goal. Fixed funding, they would just give it back to the sources if you didn't meet the goal. So that's why you need to do that. Usually crowdfunding platforms take about 5% of the donations as their form of payment. So you got to get donors excited about donating before. Look, crowdfunding to succeed, it relies on you and your social network's ability to share. Don't think that just because you run a project on Kickstarter, it's going to take off. It will not, unless Kickstarter sees your project has a bunch of donations and traffic, then they show it to more people and it can go viral. But you're going to have to start it by getting it massively shared. Evoke emotions, okay? Urgency, novelty, scarcity, cool factor. Hey, this is something novel. It's something cool. It's different. You got to get it now or you won't be able to get it. You know, If you don't contribute to this campaign, this product may never be created. It's about invoking those kind of emotions to actually succeed. And again, with crowdfunding, another thing, tip for success is line up investors before you actually start the campaign. That way, the minute the campaign starts, you've got investors donating, it's going viral, and you're giving Indiegogo, Kickstarter what they need to really make the thing go viral. Building business credit. So if the business owner doesn't have good enough FICO score to qualify for some of these options, well, it's time to start building business credit. Again, I think you should fix your consumer credit as well. But the bottom line is, if credit is your weakness, then build your asset to be credit by building your business credit. It makes sense. It offsets the weakness of your consumer credit. But again, you should be building business credit even if your FICO is good. It doesn't matter. Look, business credit helps you do two things: get the most amount of money for your business and do so at the best terms. It's that simple. If you want to get the most amount of money at the best terms, you need to build business credit. If your personal credit's excellent, great. You're still not going to get the best terms on business funding until your business credit is good. If your personal credit sucks, well, guess what? Great. Go build your business credit, give yourself an asset that helps you get better terms on the funding you have, and then get with a professional company or work yourself to fix the consumer side of things as well. So because business credit can help a business at any stage of the business, you can get this money as a startup, you can get this money for expansion, so it's needed all the way through the process. Now, when we talk about this business credit, it usually starts with vendor credit. Okay, so that means you're getting credit with initial trade vendors. That's easy to get. There's no credit pull. And they'll give you about your first 5 to 8 accounts. No credit pull. They report the credit you get to the business credit reporting agencies, helping you build initial business credit. Uline, Quill, Gimplers, Granger are some examples. Then when you have 5 to 8 trades, then you start getting revolving store credit. Walmart, right? Amazon. This is when you start getting credit at places like Apple and Office Depot and Staples and a lot of those places. Now, sometimes in order to establish good store credit, you need to buy some things you may not need to buy, right? You may need to go to Quill and buy your office supplies versus Staples at the beginning. But again, it's kind of a rite of passage to be able to build the initial business credit profile and score. So there's about 10 accounts reporting. Well, then you move on to fleet credit, auto vehicle repair, maintenance, fuel, Chevron, Texaco, Wex Fleet, et cetera, et cetera, et cetera. Usually kind of fuel cards or for maintenance repairs. Look, if you own an accounting company, this probably isn't going to matter because you don't have a bunch of drivers on the road. But if you're a truck driver, well, then fleet credit's everything to you because it's how you fill your gas tanks and how you maintain and repair the actual vehicles. So when you have 10 to 14 accounts, then you can start getting Visa cards, MasterCards, American Express, cash credit, accepted in most places that store credit isn't. Auto vehicle financing comes at this point as well. Now, again, purpose today is not to show you how to do this. If you want to learn how to build business credit, go to creditsuite.com/EIN and get a free guide, creditsuite.com/EIN. You can also go to facebook.com/creditsuite. Go to our messenger, type in the word EIN. We'll notify you every week when we go live on Facebook, and you'll get a free guide that will map out the steps of building business credit there as well. So been in business 6 months. Whew, think about this, guys. Whew, we're just startups. That's it. We're in the very first stage so far. All the funding we've talked about so far works for you just as a startup. We haven't even got to being in business 6 months. That's where to start from there. Okay. Now we can also talk about Fundbox. Remember, PayPal, Square, Fundbox, about 3 to 6 months in business, these options start to open up for you now. Okay, now they do 2 kinds of financing. And again, you can go to creditsuite.com/Fundbox to get the best deal with them and to get a link where there's no credit check in the beginning for them to take a look. They do invoice financing, where they basically are looking at your account receivables and give you up to 90% financing against the account receivables. Account receivables is when a customer pays you over a period of time. They pay you on terms, so they owe you money. They bought something from you for $1,000 and they agreed to make 4 payments of $250. They made the first payment. The rest of the payments that are outstanding, that's account receivables. Okay, so they can look at these account receivables to be able to get you approved. And typically what they're going to want to see is they're going to want to see you have some kind of software like QuickBooks that's tracking these actual receivables, okay? And what's nice is they'll basically come in, instead of you waiting months to get paid, and advance that money to you right away at a very low interest rate, okay? Usually less than 5%. Now, they also offer lines of credit that has to do with your revenue. So you can get a line of credit $30,000 within an hour. You can get up to $100,000 if you supply tax returns. And sometimes they're starting to want credit checks with these higher approval amounts. No credit score requirement in the beginning when you apply. They just basically connect to your business bank account. So Fundbox is really showing this is kind of the future of lending. They're doing what's called artificial intelligence in the funding space. Since what they're doing is they're going and getting your bank account data from your bank directly electronically. They're getting your account receivable data from QuickBooks, your software, electronically. So what this is doing is it's helping their computers make decisions faster, which is why you can get money same day or next day, which is insane, by the way. I mean, a year ago, 2 years ago, I never could have told you that you could get a credit line in a day. But now, because of artificial intelligence, it's become possible for you to do it, okay? Because they're getting the data electronically. One, the approval's faster. Two, they also don't need documentation from you. So it's a super fast way to get it done, unlike where you need bank statements and account receivable history and your AR report and all this stuff. You don't need any of this stuff because of this artificial intelligence that they're actually using. Okay, so Square and PayPal, so both offer bank loan or both offer loans, no credit check. It's an option where when the startup is just starting to become profitable. So both options are dependent on sales because, again, they're going to give you about 30% of whatever your sales with them actually are. So Square offers loans from $500 to $100,000. Eligibility depends on a company's sales history with Square. So again, not for brand new businesses. You need to have 3 to 6 months history with them. You can go to squareup.com/capital to get approved. PayPal, they offer a maximum loan amount of up to 30% of annual PayPal sales, $5,000 to $500,000. That's a lot higher than Square. Okay, PayPal goes up to $500,000 now. A company must be in business for at least 9 months. Okay, now, here's the deal. PayPal has 2 forms of financing now. They bought a company called Swift Capital that does merchant cash advances. So they now have a funding program that you may have read about if they send you direct mail called Loan Builder. They bought Loan Builder from Swift Capital. So they have a revenue product that will get you money, that will lend you money based on the revenues you produce, even if the revenues were not with PayPal. But then they also have a loan with no credit check where you can get up to 30% of PayPal sales as well. So you have a couple different options. So how can companies in business for 6 months help themselves? Well, again, a lot of things. Don't overdraw accounts. You're going to learn your bank account history is very important. And let me teach you something that not a lot of people know. There is a credit reporting agency that keeps track of how you handle your bank accounts, how you manage your bank accounts. You probably have heard of it before. It's called ChexSystems. So ChexSystems, you got to be careful because ChexSystems actually tracks if you overdraw your bank account. It tracks non-sufficient funds. It tracks closed accounts. So you need to pay attention to this stuff because, first of all, a lot of banks are looking at your bank account, whether it be electronically or when you physically send over bank statements. They're looking to see how you manage your bank account. And I just did a whole webinar. You can look on our YouTube channel on what banks are looking for. Actually, this was on Facebook Live. This was exactly what banks are looking for when they look at your bank statements. Things like non-sufficient funds, more money going in the account than going out, having consistent deposits, having the revenue that's going into bank account increase from month to month. That's what they're looking for. You need to make sure that you're managing that bank account that way. A lot of lending options will open up for you. The consistent deposits, not overdrawing accounts, keeping bank account balances as high as possible. Remember, if you're ever going to go into a bank to get a loan, they're going to pull what's called a bank rating, your bank credit score. It's primarily based on how much money you have in your account. As a matter of fact, you can't even get an SBA loan unless you carry a minimum balance of $10,000 in your bank account. So keep that in mind as you start going for higher levels of financing. Those are some things you can do to make it in the months to come where you'll be able to open up even more funding options. So 12 months in business. Well, a company been in business a year has a lot more options. One is merchant cash funding. Now, another is revenue lending or revenue financing. Merchant cash funding has to do with the deposits going into Visa, MasterCard, your credit card deposits. Revenue lending has to do with how much money is going into your bank account in general, per se. Businesses can help themselves by not writing off all profits at the end of the year. Again, that's a big deal. I already talked to you a little bit about that. So merchant cash advance is a lump sum payment. The business pays it back with a percentage of future revenue. Startups don't qualify because they typically don't have revenue. You got to be in business about 1 year for that to work. So merchant cash advances, basically, what they're doing is looking at the total deposits you have in your bank account from credit card transactions, Visa, MasterCard, Amex. They give you about 10 to 12% loan, or 10 to 12% of the funding of that amount. So whatever you do, so if you do $1 million a year in revenue, they'll give you 10 to 12% of that. That's a $120,000 loan based on your revenue. That's how that works. Now, revenue lending, very similar, but it's based on how much money you have going through the overall bank account. So base revenue funding and merchant cash advances, basically, just for definition purposes, you're not really getting a loan. What you're actually doing is selling future revenue to the lender at a discounted rate for money. That's what's happening. So you're selling future revenue to them for a fee. That's typically what it really is. Not that it matters, but at a fundamental level, that's what it is. So again, a lot of cool things because you can get money based on revenue alone and be able to use that to grow the business. So for the record, this is what you see on Facebook. You see this advertised everywhere now. If you've been in business 1 year and have $10,000 a month in revenue, you can get this kind of financing. All kinds of options open up for here. This is the space where most alternative lenders live, right here. You've been in business 1 year or more, all kinds of loan options open up along this kind of revenue merchant type financing. So businesses showing a profit. With tax returns, there's even more choices, okay? Lines of credit, term loans. What are these? Lines of credit or lines of credit lines you could use and reuse with super low interest rate. Term loans. You need to know this. You need to know this term loans. Term loans means longer term loans. Most of the ones 12 months in business want to give you 1 year, 6 months, 3-year loan. Term loans can be 3, 4, 5, 30-year loans. So the longer the term, the lower the payment. So many people are concerned about interest rate. Stop. You write all the interest off at the end of the year. The interest rate you get's based on your risk. If you don't like the interest rate, then stop being high risk. But what you'll learn is that the payment term matters more. The term matters more to your payments than rate. So don't be all caught up in rate. Focus on term. If you want the lowest payments, term is more important than rate to you when it comes to payments. So you need to make sure that you're coming in and you're doing these things like claiming profits on your tax return so you can get to these longer term loans. So tax returns also mean a company has more time in business because you've been in business over a year. So SBA loans, once you've been in business 3 years, start to then become an option as well. Lines of credit. Agreement between a borrower and a bank or a private investor that establishes a maximum loan balance that a borrower can access. Okay, that's what a line of credit is. Term loans. A term loan is a loan from a bank for a specific amount that is specified a repayment schedule and fixed or floating interest rate. That's from Investopedia. Thank you, Investopedia. Mortgages, car loans, student loans are all non-commercial examples of term loans. But again, in my space, commercial lending, I reference term loans for anything that's a longer term loan, 3 years, 4, 5 years, or longer. So these are longer term, lower payment loans. Let's not forget about SBA. Businesses can help get SBA loans by accumulating assets. SBA is going to want you to have collateral or assets for 75 to 100% of what you're borrowing. The number one asset that is used for SBA loans is account receivables. We talked about those earlier. That's the number one asset that is usually looked at for SBA loans. If they look at all your business assets and it's not equal to the loan amount, then they come after your personal assets, including your home. Account receivables are common collateral, as I mentioned. They need to let customers pay them through terms. We talked about that a little bit. So funding through the recap, funding of what we've went through today. Business stages defines which funding options are available. Startups, you can get 401k. You can get securities financing. You can get angel investors. You can get venture capitalists. You can get grants. You can get unsecured business lines of credit that we talked about. You can get crowdfunding as well. All great sources. Building business credit helps out here, pays dividends later. All these are great options for startups to access capital, one, and start setting the foundation you're going to need to start moving into other financing. More seasoned companies. 3 months, 6 months in business. Now you're at Square. Now you're at PayPal. Now you're going to creditsuite.com/funbox for Funbox. Okay. Now you're starting to get into merchant cash advances and revenue lending. Those typically open up about 1 year in business. Now, there are some lenders that will lend as little as 6 months in business with revenue lending or merchant cash advances. So 6 to 12 months, those options start to become available for you. And again, building business credit at any stage provides to be very beneficial. And even though I didn't show this in the summary, the next is once you have tax returns in 2 years or so in business. And that's when you start to get SBA loans. And somewhere in between 1 to 2 years, you have tax returns. And if your tax returns, your first one show a profit, then you open up term loans. Then you open up line of credit. Then with 2 to 3 years tax returns, then you move to the ridiculously end final stage of SBA loans. We call this graduation. You usually start with startup kind of financing, 401k, stocks, bonds, grants, crowdfunding, unsecured business financing, business credit. You graduate to the next level as you accomplish more time in business, 6 to 12 months. You get to Square, you get to PayPal, you get to Funbox, you start to get to those options. Then as you get to about the 12-month mark, you graduate again to revenue lending, cash advances. You have a year's tax return, so lines of credit and term loans in 1 to 2 year time frame all become available. Then you get to the final graduation, the grand finale, 2 to 3 years of tax returns in business. You have cash flow, you have credit, you have collateral. The very end of the process is SBA loans. So we've done it. We walked through a ton of options for you, all the way from startup, all the way to major expansion that you can qualify for. Again, if you want to know what you can get now, go to creditsuite.com/get funding. Quick approval you can go through, pre-approved for every legitimate kind of funding in one place, over 1,000 lenders. We never charge you a dime to get money. That doesn't mean the money's free. Lenders will charge you. We negotiate to even get you better terms than you get on your own, but you still have rates and terms, and we could talk to you about what rates and terms are on any kind of financing you may qualify for. And if we can help you along the way, then reach out to us directly, 877-600-2487, info@creditsuite.com. Make sure you like us and make sure you leave us a review. If you're listening on iTunes, and like and subscribe if you're watching on YouTube. As a matter of fact, feel free to go to creditsuite.com, top right of our page, access our social channels. We go live on YouTube weekly. We go live on Facebook weekly. And daily, we're releasing tips, tactics, and tools on places like Instagram and our other social channels as well, including Twitter. So anything we can do to help you along the way, visit us at creditsuite.com. And there you can access our email, our phone, and all of our social channels where we have more training like this. That's all based on helping you obtain money for your business, getting the most money at the best terms. Almost all of our trainings revolve around that: how to get business credit, how to get financing, how to work with consumer credit, everything you need to know to accomplish getting the most money for your business at the best terms. Thanks everybody for tuning in today. I'm going to wrap up. I will see you next. Let me see if I can pull up the topic for next week. I will see you next Monday at 1 o'clock Eastern, where we talk about everything you need to know about getting money for your business, especially through products that we haven't talked about today. So tomorrow we're going to talk about even more financing options, next week, even more financing options to help make it easy for you to be able to get the most money for your business at the best terms. Thanks everybody for tuning in. Hope you all have a great day.